Welcome back, Investorholics, to another ETF Spotlight review. Today we will be taking a closer look at SLF, which is the State Street Spider S&P ASX 200 Listed Property Fund. So if you're an investor seeking exposure to the Australian REIT sector and chasing a stable income stream, then SLF might be worth a closer look. The sharp coronavirus-led correction during the first quarter of 2020 has affected markets globally, but the property sector was one of the most severely affected. Obviously, once people can't go outside, so everything gets closed down. So if people can't shop, that's a big effect, or go into the office, has a big effect on these real estate companies. So up until the end of December 2020, the fund recorded returns of negative 4.54% for the calendar year. However, 2021 could be a positive year for REITs as the effects of COVID-19 subside and people return to offices and shopping centres. So it's something we'll just explore as we go through the video. Don't be afraid, guys, to leave a like and subscribe. It really helps me along. Obviously pushes the video out to more people as well, so broaden the viewership. So please like and subscribe. Hey there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at KrackTheSky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up and also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, so SLF seeks to closely track before expenses and fees returns of the S&P ASX 200 A-REIT Index. They're tracking, so SLF is actually tracking a part of the index, so sub-index of the S&P ASX 200. The index tracks performance of the Australian real estate investment trusts and mortgage REITs. Why are we bothering with this one? So potential inflation hedge, so real estate assets might help to offset inflation risk. Diversification, so we've got low cost exposure to Australia's largest listed property trusts and investments across different locations and sub-industries. So as we sort of mentioned before, we're looking for income, so capture property income in a form of dividends, potential for franking credits as well. So three reasons to have a look at this one. Okay, we had a net asset value of $11.82, trading below that at $11.73. Market cap of $568,300,000, so it's quite large, or relatively large. Management costs of 0.4% per year. Distribution frequency is quarterly, so dividend in January, April, July, October. Dividend yield of 6.27% or thereabouts. So SLF aims to fully replicate the S&P ASX 200 A-REIT Index. The benchmark consists of around 22 predominantly a large cap Australian listed property names. So the Historical returns, though attractive, must be looked at carefully, and investors should be cautious while evaluating the future potential returns of this one. So, recent report out by S&P Global Ratings reported that 200,000 Australian households shopped online for the first time ever in the month of April 2020. So, just after sort of the COVID shutdowns and that type of stuff happened. So COVID-19 has driven previously reluctant customers online and encouraged online take-up at a much faster rate than S&P had witnessed in the past, and obviously everyone sort of knows that from their own personal experience. So S&P believe that much of this online shift represents a more permanent change in consumption trends. I mean, that's all really their opinion, so it really we have to wait and see if that really plays out. So 2020 could be a positive year for REITs. So as people head back to the office or leave their homes and go shopping on a more regular basis, heading out to those large shopping centres, which are owned by REITs, majority of those big ones. So looking for an uptick in earnings, I suppose, over the next 12 months or so. So it should be, I think it'll be positive anyway. But like I say, everyone has their opinion. So SLF is a reasonable, reasonably sound choice for investors seeking exposure to the Australian REIT sector. SLF could also be appropriate for an investor interested in generating a regular income stream, for the relatively stable dividend payouts. So, I mean, that's sort of one thing we're kind of looking at the moment, is how the dividends are going to be affected, or, because of people coming back to the shopping centres quite rapidly, the dividend's going to lift, but, really we're not going to know that until sort of, in the middle of the year, I'd suspect. So for looking for alternatives, as we always should be, we should be looking at also MVA and also VAP. So do some further research on those ones, and also catch the videos. I'll leave the cards in the top right hand corner. Okay, let's take a look at the big top holdings. So you got Goodman, Centers, Stockland, Dexus, Mirvac, GPT Group, Charter Hall, Vicinity, SCA Property Group, Charter Hall Long Whale. Performance since inception, you're looking at 6.76% per annum, which isn't too bad. Reasonable return over the lifetime of the ETF. So I think it started sort of 2002, 15th of February 2002. So it's got a pretty good track record. I mean, you're not going to shoot the lights out here with a lot of growth, but it's going to be reasonably consistent, and also depending on sort of the themes that we've spoken about. Is there going to be a big crash in the amount of tenants in some of these shopping centres and office buildings? That sort of really has to be played out yet, so it's a wait and watch sort of situation. The Australian REIT market is quite concentrated, with the top 10, as we sort of just went through then, making up 86% of the portfolio. Considering the limited opportunities set in the market, it's difficult for managers to create significant alpha generation prospects. So that's why I think the passive strategy is a quite a worthwhile option. And, if you're looking for domestic exposure to real estate, anyway. Another good thing about this is because the holdings are so stable, you're not going to get a lot of frequent changes in the index. So the numbers sort of say that there's about 2% turnover, so it's really, really low for an ETF. That means the transaction costs are kept to a minimal. Morningstar thinks that the share class will be able to deliver positive alpha relative to the category benchmark index. I can get that out without tying myself in knots. So same rating as when I reviewed the ETF 2 years ago, I think it was, 18 months ago. Morningstar still give it a bronze rating, which is a 3 out of 5 stars. So yeah, I think it's one to have a deeper look into, but there's always the risks associated with COVID-19, and really, are you going to get the pickup of people coming back to shopping centres and people going back and working in offices? I think industrials, I think fine, but that's one of the ongoing risks is, are people actually going to come back and shop and work in the office as we did previously? One to consider, but yeah, I think this is a decent option if you're looking for exposure to retail, or the biggest listed property REITs on the Australian market anyway. So spread your risk by buying this ETF instead of just looking at one. So yeah, spread the risk and get the top 22 in one package. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.